Yesterday was that famous last day of extended tax filing day. So many of you, if you're a procrastinator, maybe most likely you won't be in this webinar if you're a procrastinator. You must be somehow a really good planner. But yesterday, there's a lot of procrastinator was here because we're getting the last minute tax done. We even have taxpayer who owes like close to $250,000 taxes and decided to file taxes the last 2 hours in yesterday's last day. So those are the people really need to listen to tax planning webinars because you want to get into the planning mode. Anything in life, if you plan, you do better. And if you casual and take it as it is and don't care, it is still a lifestyle, right? It is really okay to have that kind of lifestyle, but this webinar is not about that. This webinar is about knowing what's out there and increasing tax efficiency. That's what I called for your business and for yourself. So let's get into what we like to talk about. No responsibility disclaimer, of course. And you hear me talking about that. Just be responsible for what you learn from internet. And what you learn from Ying, you can always verify with me. You can challenge me. You know, the biggest challenge I have in my professional career, you know who is my biggest challenger? If I tell you, you don't believe me. Actually, my husband, Dr. Howe, is actually my biggest, greatest, most serious challenger to everything I do, because he wants to make sure that I am actually be responsible for what I'm saying. He's a scholar, so he makes sure that I'm doing the right thing. Okay, here we go. Number one big things when you plan taxes, you got to engage yourself to understand tax bracket. We call that tax bracket management because you want to really understand what is the tax bracket. For 1040, for example, you have these 10% all the way to 37, and the Biden administration is proposing that 37 to be about 40%. So they're increasing the tax bracket. So the bracket is important because you want to know where you land. For example, in Biden's proposal, and it says that if your AGI is more than 400,000, so in this, the AGI 400,000, that's the number is going to apply those tax rate. And they consider if you have $400,000 total income on your 1040, there's a whole bunch of deduction, whole bunch of benefit, tax saving things that you have in 2021 will not exist in 2022. So that's why we say that you really want to manage your tax bracket. I have a table here for you, so make you feel a little bit more tuned in. And then look at that. This is 2021, okay? This is the year that we want to plan. And it says that if you make anything under 9,000, 10,000, it is 10%. Then up to 40 is 12. And so this is where I give you the single individual one, married, jointly, and head of a household, right? So you kind of see the number. Let's say if you're married, joint filer, and you're, you know that you got some short-term capital gains going on, and you are going to go over 400,000, then you are looking at 32% of bracket. You see that? So of course, it is not like your 400,000 is all gonna times 32, because we're not a flat rate like a corporation, right? So we are a progressive rate, and so the under 9,000 is still gonna be 10%, under 81,000 still gonna be 12%. So make you we call that effective rate is probably right around 25% if you get up to 300 to 400 grade. Okay, so manage your ratio, so do your math, and then you will know that the taxes is where. So when your tax preparer come out and give you a big bill to pay, and you're not surprised because you already calculated with your bracket, with your understanding, right? So of course, other than the federal tax bracket, and you also have state taxes that you need to plan. So let's say you just, you just happen to, develop a relationship with someone who actually lives in Nevada instead of in Minnesota. And then you were trying to decide where, one of you going to move to with the other person. So this is where state taxes might come to play, because some states don't pay taxes at all, right? And for instance, the state, the Iowa, Minnesota, California, those are the three states we have the most of our clients, and they all have a graduated tax rate. Means the tax rate are going up from 1 to 10, anywhere in between. But some states don't have income tax at all, like Florida, Texas, Nevada. So those are the places people do go. And we have people lives in Iowa and have a home in Florida. They stay in Florida and they get a Florida driver license, and they still come back to Iowa, but they're Florida residents, so they don't pay income tax for their stuff they get, because of their Florida residence. So that come into play. So when you do your taxes, and I know you can't be moving around all the time, but who knows? Because with this pandemic period, people suddenly realize they can work remotely. Am I right? And so what's going to prevent you from working of your work in a different state? If your employer allows that, and you're not even in the state that paying taxes anymore. So it's really where, planning comes, planning will benefit you when you think how the state tax applies to you, right? So let's look at this one. And other than tax bracket, and I really want people to understand the tax deduction and the tax credit as well. This is a very good slide. And I one time used it in my other webinars, and I brought it back in here because I really want people to understand what's the difference between tax deduction and tax credit. Because other than the tax rate where we're given, wherever you live, you already knew what kind of rate you're going to be applying to your taxes, to your income. But there are things you can deduct. You can lower your taxes, right? So there are two things you can lower your taxes. One is called the tax credit. The other one is called tax deduction. Let's look at the difference. Let's say your total income is 100,000. Okay, I have one column for 10,000 tax deduction. I have another column for 10,000 tax credit. And that tax credit could be, say tips credit if you're a restaurant owner. Okay, and it could be historical tax credit if you're a construction person and working on project that give you tax credit. Could be work opportunity credit. Okay, there could be all kind of credit coming in. So that 10,000 tax credit, look at that. You have an AGI of 100,000, and then your taxable income is 100,000, and pretend your tax rate is 25%. Then your taxes in under the second column is 25,000. So you pay 25,000 of taxes, right? See that 10,000 tax credit came in, reduces your tax. So you only pay $15,000 tax. But look, the other column on your left, and that 10,000 were reducing your income. So your 25% tax rate applied to taxable income of 90,000. So you calculated taxes is 22,500. Sure, it is a lot less than 25,000, not a lot less, but some less, right? But it's still not as good as the tax credit. See the difference? So, and if someone shouts, we'll give you $10,000. The next is tax deduction or tax credit. The cheers should go to tax credit, right? So as long as you qualify for that, then you can actually dollar to dollar reduce your taxes. That is why sometimes I have a webinar in YouTube where we talk about the business tax credit. And in there is a tax credit for setting up 401k plan, and where you can have up to $5,000 tax credit. And you know that 5,000 is not 5,000 tax deduction, folks. That really reduces a lot of taxes. Look at how much it reduces from 25,000 down to 15,000, right? All right, so this is where the rate, the tax deduction tax credit is really important. And then the other thing is, for small businesses, we want you to make sense of the accounting method, accounting years. Okay, so fiscal year. So what is a calendar year and a fiscal year, tax year, accounting year, all of these years. So you want to make sure that when you work on your planning and you utilize those concepts into make that tax efficient for yourself. So IRS believes that, IRS says there's only two types of years IRS has. So IRS has a calendar year. IRS also have what they call the company's fiscal year. So for seasonal business like, you know, lawn care will be critical. It will be very typical of a seasonal. Christmas lighting and stuff that's seasonal, right? So when you have a seasonal business, what does that mean? That means you're generating business in a more concentrated manner, right? You Christmas come and you did all your Christmas selling and the Christmas working, Christmas serving, and then by the end of in the middle of January, and you are just like having a lot of income not just coming in. And if you just pay taxes right there, say your year is the end of December, so you sold a whole bunch of things and you haven't even paid your supply yet, so but you got a lot of income. Then if you at that time start paying taxes, then you are getting a lot of income that you haven't even turned around, you're already paying taxes. So the fiscal year for seasonal business, the theory is that you will give your beginning of the year as where the most of the income coming in. Then the rest of the year you can expand spending and do whatever you need for the business. By the time you file taxes, your income and expenses are properly matched. Does that make sense? So you want to match your income on the top, expenses on the bottom. The reason I say that is, sure, someone could argue that, well, what's the point? Because I spent a lot of money from January to November. I made a lot of money November to December. January minus December, I'm good to file taxes. Nothing wrong. And you can do calendar year, but the disadvantage is you do not know how your earning would be, because normally business owners don't we based on what we make to decide what we do tomorrow, right? So you really want to make your December the first month and make your November next year your last month. So you made money, then you know how to spend it. And you also know how to spend it in such a way that you will pay the least taxes. So this is where the seasonal business coming in. It is very important. And it is not a cycle that you think, you know, whatever that is okay. No, it's not. If you really want to run a successful business, you should put your income in the beginning and the spending as you need it, and be tax efficient at the end. Then another new year starts again. So fiscal year. Okay, that's what I'm trying to say to you that you should consider if you are in seasonal business. Then of course, what about accounting method? So I kind of touched a little bit. You know, when you are in retail business, a lot of times the supplies coming in and you don't pay them. Your supply coming in, you have 30 days to pay. By the end of 30 days, your supply is already sold. Am I right? So in this scenario, if you are a retail business and you choose to be cash method, and then you sold stuff you didn't pay and you cannot deduct those things, right? Because you're only going to deduct the one you spent. You're only going to report the one you receive. So accounting method is actually really critical in terms of what exactly you want your book to be, and whether it's on cash method, accrual method. And the best example is dentistry. The dentist or the doctor office, they don't want to be on accrual because they submit money to the insurance company and to get paid. Insurance company takes 60 days, 90 days, since Obamacare, the whole system get really shaked up and it's not working. The doctors and the dentists, and they don't even know how much money they're getting from the insurance because there's so many things that they just can't handle that kind of details. So they're waiting for money to come into their bank account. Whatever they make, that's their income. Imagine if they're going to do accrual. So every time they submit $100 bill to the insurance might give them $50 back, might give them $60 back, but in accrual accounting, they would book 100. So you got $100 income, then later on, what you received is different. So that is a nightmare. So most of the hospitals and clinics and boutique hospitals and also dentistry office, they have no reason, absolutely no reason to be on accrual method. They all on cash method. But in with other businesses is not so, and with retail businesses you should be on accrual. So a lot of times people are doing taxes. The tax software is actually coming in the package, right? Every tax professional, they know what software they use, and when the software comes and you open up the software, you start doing taxes, they default that in the cash method. So a lot of times unknowingly, you already choose the wrong accounting method. See, tax planning is the thing that will touch on those things. So you would not have a chance to make a mistake. You would remember to tell your tax preparer that, hey, this business is on accrual or on cash method. So that's what I, want to just hone in that concept with you, because it doesn't matter how much you learn and what you do, and if you don't know how to ask your questions, and the tax preparer, they have so much going on, they may not think of that. So in our firm, we do tax planning, right? We do tax planning around this time, around the holiday season. And I really wish that the tax due is not in the winter, because it just, holiday season, we have to do tax planning. But those are, the people who need to do tax planning coming to us, and we do it in November, December. All of these things I'm talking about is on the checklist. We actually go through them to make sure the business, the individual, the business owner, the kids, the relatives are all situated in the most efficient way in terms of filing taxes. Now, let's review how your business is set up. This is another checklist we do, right? This is a very old slide. I want to say it at least 10 years old. I pull it out because I just want to show you that when you do tax planning, other than what we talked about now, you also want to review your structure, because with these new changes coming up, the tax structure you had may not be the right one. And the tax structure should not limit you into a spot, and it really meant to be flexible. So you want to make sure this picture, what I'm showing you, is just kind of show you that you see that LLC has a little dotted arrow goes S Corp, C Corp. That just means that if you have LLC, if that doesn't fit you, you can elect that to be S Corp, C Corp. And look at S Corp and C Corp, they can be changed, okay? And the C Corp to S Corp, or S Corp reverted back to C Corp, so they can be changed. Then all of these are somewhat related to your 1040, right? So, on the LLC, there's two LLC. One is in the 1040, one is outside of 1040. The one in the 1040, it is single member. Then the one outside of 1040 is the multi-member. Then, of course, you notice that I have this dotted line on the bottom. That's the C Corp. C Corp is sort of an individual, right? C corporation, the C Corp is the one that Biden is changing the tax rate. Actually, President Trump changed the rate, and President Biden coming and change it again. So it feels like it's an adopted child by both of them. They just change C corp, and C corp is the corporation that really generating a lot of tax revenues for the country, and the large companies are C corp. So there's a reason for them to look at that structure and wanting to do things differently. So, and the tax structure is a one thing when you do tax planning with us, and that will be a thing that we discuss, and to see whether you are really in the right structure. And maybe you are in the right structure, but the filing itself, it is not most optimal. So we will change that for you. So there's so much have said, and there's no way a 1 hour can cover those kind of topic. But the most important, I want you, the business owner, be elevated at a higher level. Just know the concept and apply to them. Understand them could be somebody else's job, right? But you need to know it. Knowing it is already 50% done for the business owners. Now, let's understand Biden's tax changes. And so there's quite a few things that I want to cover in this slide and next slides, because these are just really, it's just really critical. And, some of my clients, I want to work on the tax planning, and I couldn't because those things were not finalized, and we need that to be finalized before we go forward. So the number one thing I want to mention to you is, if you sell or plan to sell your business in 2021, and my recommendation to you is you should do it in 2021. Okay, there is a proposal on the table, pretty solid. It's coming from back in May, and Biden had a proposal coming, this budget proposal included that in there. Then the Congress started to do this budget reconciliation. The House, Senate started to discuss it, and I know it's in the House bill as well. So that just means it's very possible to become a law. So what happened is, if you, in the past, when you sell your small qualified business stock, and for small business owners, for business owners with a asset level under 50 million, and with business owners owning that share for more than 5 years, and several conditions, when you meet these conditions, you actually can be exempt from 50% of your capital gain. So let's say you have a business, you bought the shares for $1, you held it for a long time, and then when you sell it, you sold it for $1 million. Then half of that amount is exempted from taxes. Okay, so that is something that I want you to know, and you have that in 2021. But what Biden's proposal, Congress and the House bill says that they want to limit that benefit to people with $400,000 above income. So if you are high income earner and they want to diminish that, they want you to pay taxes for it. So that is a lot of taxes. If you had a $1 million capital gain for selling your business, and 12, the section of that is actually called 1202, section 1202. If you qualify for that in 2021, you may not qualify for 2022. Then you will be paying double of the taxes what you would pay in 2021. So that is important, and I want to put it here. And it doesn't mean that today you listen to me, doesn't mean that you have that. But if anybody with that kind of, they already did that kind of sell, and it should let them know. And if you have a loss, there's also a favorable treatment out there. So people should not walk away from losing and celebrating paying incorrect tax amount on the gain. So both ways we should avoid. So make sure that that's the big change. C corporation rate is changing. So right now it's 21% flat. Whether you make $1 or you make $1 billion, it is 21%. But Biden's proposal and as well as the House bill, and indicating that to be a 28%. So, some of our client can clearly not going to be beneficial to stay as a C Corp. So when we do tax planning based on your situation, based on we know what's going to happen in 2022, so maybe in 2021 you can still stay the way it is, but making an election to become S corporation, or maybe reverted back to limited liability company. So there's things that should happen, and when you do the tax planning to ensure that you are not going to be stuck with a higher tax rate for no good reason. And as corporation owners might face more taxes. This is another change that coming through Biden's proposal. Back in May, when Biden, the White House come up with this budget and with this tax plan, right? Whatever budget they come up, they have to have ways to get the budget paid. So one of the way it is to, of course, is to change the tax code. So one of the changes related to S corporation is, how S corporation owners, they receive K1 and that's not subject to self-employment tax. And in Biden's proposal, it says that to charge self-employment tax. So we're talking about turning S corporation K1 completely like like some of those 1065 K1 and getting charged with self-employment tax. That's going to go away with a lot of benefit. So the House did came up instead of don't think it has a proposal for the 15%, but it did say that to put on 3.8%, which is having S corporation K1 pay more taxes. So this is where we are watching really closely. Of course, 2021, when we do tax planning, you can still stay with the way you are, and we're not going to putting on the 3.8% for you because it's still a proposal. But not to say that some of those implementation can go backwards. They can go backwards into 2021, saying that this will be effective now or back then in April or in May, but not likely. And the S corporation things, and most likely it's going to be 2022, even though they have a right to revert back to this year, current year. So if it is 2022, folks, when you do 2021 tax planning, you should have a plan for 2022, right? There's other consideration that I want to mention to you related to Biden change. This should be considered into your tax planning. So make charitable contribution. Remember, they used to have this limitation of 60% AGI. Like you can, let's say your AGI is $10,000, and if you donate too much, they don't let you. They suspend you to next year, right? So 60% AGI means you can only donate 6,000 if you have 10,000 AGI. So that is, remember during the pandemic time, I think it's CARES Act actually took that out and giving 100% deduction in 2020. So that is going to be here for 2021. So there's no proposal. Biden's proposal did not including that. So that is going for sure. So do charitable donation if you can, okay? And pull income to 2021. The reason I say that is sometimes, remember, at the end of the year, you got to check. And if you're on cash method, you deposit into 2021 is your 2021 income. If you deposit that into 2022 is your 2022 income because you're cash method, right? And consider, because the rate is going up in 2022, so it depends on which tax bracket you're in, and then you might consider pulling income into 2021. So-called pulling income is not just about the check deposit, it's also about your retirement, and you can convert. You can convert traditional IRA to Roth IRA by pulling income into 2021 because the tax bracket is lower, or because of the rate gonna grow next year, what's the point? If you're going to do that, you might just do it in 2021. So make sure you talk to your financial planner, and we work with number of financial planners at our firm. We ourselves are not financial planners, and we give the financial planner's job to financial planner. And in fact, I don't believe financial planner and a tax planner are the same people on the same planet. And one is from Mars, one is from Moon. I will tell you that they're very different. For example, I consider myself, I have a dual views. I understand how each profession is doing, but the tax professional, when they do tax planning, they're very practical. They are focusing on, they're historians. They're historians looking at your last year's taxes, filing your 2020 and 2021. Okay, so they're very practical. They know what happened yesterday, and that they have a short vision for tomorrow. So they want to make sure that they get your taxes. They make you be cash efficient for the current year. Okay, that's your tax folks. But your financial planner folks are on the moon, and they're blue sky creamery kind of people, and they want to give you the future projection that is so rosy and nice, and you're going to put every penny you have into the future. You know, they are in that profession. Trust me, they believe in it. They're not even faking. They really believe that you're going to make $1 million if you put $1 in there. So whether that become a reality for some of their clients, maybe that's why they can be so enthusiastic, but didn't happen to me. So I don't really, I'm not really that into futuristic, and I'm more of a tax mentality for today. So for that reason, you need to find your financial planner, and your tax people not going to be your financial planner, and have them give you the future look, and have your tax people be practical. So that way you have the best of the world. Okay, and for that reason, I say that converting traditional IRA to Roth IRA, that's kind of your financial planner's decision. And of course, if your financial planner talks to your tax planner person, then you have the best of the world. And this is the point I'm saying, pull income to 2021. Okay. The other thing that I want to mention to you is the retirement part. And a lot of small business people, hey, we're just really price conscious, right? We didn't want to pay a lot of money to do a 401k plan. It just really cost us a lot, and we don't want to do. And let me tell you this, might cost you $3,000, $4,000 a year for having a profit sharing 401k plan and to do some awesome deduction. But if you don't do this awesome deduction, if your tax bracket say is 40%, and here you can put away almost 60,000 a year. If it is 40% on your tax bill, and you can put away 60, and you're saving 24,000. Who cares about $5,000 cost? And plus those $5,000 cost to set up your 401k plan and all that, it has a tax credit waiting for you. So why are you not taking those advantage? So please, and know that the 401k plan or SEP IRA, to set them up for yourself, for your employee, it is very tax optimal, and it is efficient, and you should really looking into that. So I give you some numbers here. If you're over 50 and in 2021, you can put total of 64,500 away. Okay, so I know some of our small business owners says that, Ying, I don't have 64,500. But then I will ask you, do you have 64,500 on your W-2? A lot of you would say, yeah, I pay myself. There you go. And why are you not have 64,500? Because part of that amount can get away, can be on your W-2. So you don't pay taxes. You have the money becoming yours and no income tax. Wouldn't that be wonderful? And this is where that a lot of our small business owners didn't really come to realization about how good it would be. So look, for SEP IRA is 58,000, and for 401k it is 63,500 total. And if you're older, you got if you are younger, you have 58, but if you're older, you go up to 64,500 in 2021. Okay, so this is where when I do tax planning, a lot of that I come through. So I look at what you are paying your taxes, I look at your household cash flow, and I know that 60,000 you don't need that, and then we can put away for your future and also save your taxes today. Okay, if I can save your taxes today, I don't care about your tomorrow, because tomorrow the president is different, the tax is different, and there is no such a thing about long-term tax planning. Tax planning is always short-term. The only so-called long-term is the investment inside your 401k, and your financial planner is the one responsible to make that dollar work inside of the plan. So when you look to see the balance one day, you needed it. Instead of 64,000 in there in 1 year, you actually grew that amount to be 640,000. So that's the goal the financial planner need to have. Now, my point over my last bullet point in this slide is mark to market. The reason I brought this one here, because you would not believe how many calls, how many consultation work we have done this last 2020 tax season. People are struggling with the concept of mark to market and thinking, oh, wow, I want to have this done, but not knowing how complex behind it. There's so many mistakes being made by the taxpayer. Some people lose money for making mark to market. It's supposed to make tax efficient move, but becoming a costly endeavor. So I want to just say that mark to market, it is a accounting method. And you remember I was talking about cash accrual method. There is a special method called mark to market. So normally in your investment portfolios, and you trade, you sell, and then you got this 1099B statement, then you report capital gain, capital loss, right? And if it is capital gains, if it is you do a lot of wash sales, the wash sales losses got disallowed. So you look at that loss, you go, man, I wish I can take that. This is where people goes, I want mark to market. What they're thinking is that loss can be deducted right away. That's not wrong. Yes, if you mark to market, you can deduct that right away, but you got to think about your business process, because in your normal business endeavor, you are profit driven. You should make money in the end, right? If you did a mark to market election, you become a day trader business status, and when you make money, and you will make money and pay Social Security, Medicare, that's a 15% on top of your regular income tax. And do you know that if you do investment on the long term doesn't mean lifetime. Long term means you hold that stock for more than a year. That's not long. A year goes by like nothing. And so that kind of income is much lower taxed than regular income, like short-term capital gain. Short-term capital gain is generally taxed like a regular income. If your income bracket is 40%, your short-term capital gain is going to be 40%. But if your bracket is 40% and your long-term capital gain stays at 20%, okay, so this is where you want to, number one, consider how many of your investment is long-term. Is that worth of you to turn them into mark to market? Number two, you want to consider, yes, in 1 year, you may lost money in 2020. There's a lot of people losing money, right? In stock market, even this year, a lot of people lose, but I also have client who makes a lot of money on the stock market. And I literally call the stock market folks are, they're professional gamblers. They're really, I don't know, there's, people, on internet, you will hear people tell you that pay this price and I give you the secret so you can always win on stock market. Don't you believe them? Don't believe that. And these are just, they're commercials. They're just one way of for someone to make income. And stock market to me is a very it is a gambling ground driven by more factors than the machine, because they are impacted also by political factors. So it is a much harder to predict gambling machine. And just like you pulling the slot machine, and then the stock market has much more difficult mathematics behind it, and that chance is beyond human brain, and that's, at least that's my thing. So you should not do if you were me, don't do that. Just give to your financial planner, have them invest for you, okay? Because they have teams behind. And if you're busy with your restaurant and you made this money, you know how hard the restaurant owners are working? Are you kidding me? I'll tell you that restaurant owners are probably the hardest working people on the planet. If they made some money and blow them up in the gambling ground or blow them up on the stock market, I feel bad. So I just think that if you are the one using your hard-earned money and to do these stock trading and thinking of mark to market so you can get the deduction, think again, because you really want to use your money wisely. That mark to market election is not for everybody. And consider your long-term capital gains. Short-term capital gain is taxed on the profit from the sales of the security, the stock you held for a year or less. Okay, that wash sale came in because you bought the stock and you sell it you sell it right away, and then you bought them within 30 days. So that is where the wash sale came in. And the short-term capital gain tax rate is equals to your ordinary income tax rate. But the long term is different. So I have this table here. I want you to look at it. You see that long-term capital gain tax rate for 2020, that year is passed, but look at the bottom one, okay? You see there's a zero rate. So if you are single and your taxable income is below 40,000, you don't even pay taxes on the long-term capital gain. But if you're single, you make 40 to 400,000 and you only pay 15%. But if you go over that, say you're a billionaire as a single person and you only have 20%, there's no other rate for long term. So why aren't you do something to get yourself qualified for 20%, right? So this is more, it just really potpourris of everything related to tax planning. It's pretty much give you some ideas about when we do tax planning for you, for your business, the content we are going through. Okay, so typically at our firm, what we do is we take your 2020 tax return and we map it out for you so that you can visualize how you did in 2020. Then we get your financial input, whether from your bookkeepers or from our accounting team here. So if you have accounting done anywhere, we want that information to come in for the third quarter. So we project that to the year. Then we actually come up with your 2021. So when we come up with your 2021, we would see 2022 in the short vision. Remember, I'm not a long range vision person, so I can plan your next year, 2022. So if you are S Corp making K1 over 400,000, you are already targeted by the tax reform. You are the one, the government want you to pay more taxes, okay? So If you are that person, then we need to plan 2022 by doing things in 2021, setting it up and getting it ready, and also know exactly how much taxes we're going to pay in 2021. By the time you step into 2022, you are prepared. And we normally, in our firm, we have over 3,000 taxes over here. And we typically do not have our clients who are with us for years, they don't have surprises because we plan the taxes in such a way that you knew what's going to happen to you when the new year comes. But this new year 2022 is a little different. There is a lot of changes from Biden administration trying to get the budget balanced. So they have a way to work through the revenue and making citizens, making tax residents, making people who file taxes to contribute their share to make the country goes, right? We have so much deficit. Aren't you scared? So just like if you run your household and all you have is borrowed money, I'll be scared. So, raising taxes is almost no choice. There's no choice, and he has to do it. His administration has to do it. How he does it, of course, that's the choice of the Congress. So we just want to make sure that we sit tight and wait for the final, and then we can start diving in, be a good historian and be a good librarian and come up with a new plan for 2022, but finishing 2021. Now, my last slides, folks, do tax planning. There's so many strategies and potential savings. And of course, our firm is a resources for you, but you can also do tax planning on your own. And you can also look for free resources out there. There's so many help out there. I can think of a SCORE and SBDC offices and, Iowa Center for Economic Success. And there's a lot of nonprofit. They probably not exactly doing tax planning, but to get that education. And if you have questions, they have mentors. And if you're not into paying for professional service, those are resources you look for, or stick with us on those webinars, right? But we do in our firm, and we actually would schedule people for the planning. And if you're interested, you need to contact us early, and we will get you in if you do it early. Otherwise, we do have limited resources, and we're not unlimited in terms of manpower. And so it is really up to you for how you want to get your business in order, how you want to get your finance in order. But if you are the individual who actually sold business in 2021, and you need to come to see us, because there are so many things that you could have easily done wrong. The taxes you paid is not just what it is. It can be done differently. So let me conclude our webinar here. And this is our slide to tell you how to contact us. And the 515 number, that's a Des Moines, Iowa number. It is really our main number for the office. But if you call that number, it's actually rings for all our locations. We have a Bloomington, Minnesota location. We also have another location in East Iowa in Coralville, next town to Iowa City. And our office always open on Saturday. So Saturday is a open day for us. And we do, we do rotate our staff to work on Tuesday to Saturday schedule. So you're always gonna find someone during the Saturday time. So our firm basically opens 6 days a week from 8:30 to 5:30. And I hope you enjoyed the webinar, and I will talk to you again soon. Bye-bye.